From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for Friday, September 22nd, 2023. The Brew Crew is spending the weekend in Miami before coming back for 2 midweek series with the Cardinals. Their magic number is 2, and it's National Hug a Vegetarian and National Ice Cream Cone Day. You could top off your ice cream with peas and carrots. Yuck. A 10-year-old boy led Arizona troopers on a chase while his dad sat in the passenger seat, bombed. The Father of the Year award goes to not this guy. A Canadian woman says she had no idea why someone would send her 1,000 condoms in the mail. Well, for starters, it's a more direct approach than flowers. How about one from our stupid criminal file? Don Murray of Terre Haute, Indiana, has a tattoo on his forehead that reads, "Crime Pays." He was recently charged with resisting arrest, reckless driving, auto theft, and possession of meth. If he's going to be a career criminal, he should probably get rid of that tattoo. And finally, from Florida, a 3-legged bear named Tripod. What a great name for a bear. Well, Tripod broke into a home and raided the fridge of White Claw alcoholic seltzer. As if Florida isn't strange enough, now you have to be on the lookout for an alcohol-swigging 3-legged bear. Just what nightmares are made of. On the podcast today, we have Adam Baley, Tom Pappenfus, Joel Dresang, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. A tough week overall for the markets. The NASDAQ down 497 points this week. That's 3.6%, closing at 13,212. The S&P 500 down 2.9%, down 130 points, closing at 4320. And the Dow Jones, a little bit better week, but still negative, down 1.9%, closing at the bell on Friday, 33,964 for the year. Dow Jones still up a positive 4.2%, including dividends. The S&P up 13.9%. And despite a pretty tough week, the NASDAQ still up 27%. You know, Adam, we had the Fed speak this week. I think it's really the only thing investors have cared about for a while. What does Jay Powell have to say? What do the Fed governors, in particular the voting members, have to say about where we're headed? Not a lot of surprises. The Fed clearly pointing to interest rates that likely can stay higher longer than we initially thought, but we've been in that environment for a while, and yet markets sell off.
Yeah, and the Fed was the really only meaningful news we had this week. Not much on the economic front, nothing on the earnings front until earnings season kicks off here in October, but the Fed was pretty much it, and their message was essentially consistent with what we've had the past several meetings and the past several announcements from them. They reiterated that they're doing what they can to bring inflation down. Interest rates will probably remain higher for longer. They're leaving on the table the chance of maybe one interest rate increase, later this year. But what really changed this week and brought the markets down is we got an updated version of the dot plot. I think that was really the change from this meeting to last. As a reminder, what the dot plot is. All the voting members of the Federal Reserve have, they kind of give their predictions on where they think interest rates are going to be at the end of this year and, where are they going to be in 2024 and beyond. And you take a look at the changes in the dot plots, and all the voting members of the Fed think that rates are going to be a little bit higher for longer, certainly for the rest of this year and into next year. One interesting point is that the highest dot in the dot plot, no longer there. Mr. James Ballard retired. He's the St. Louis Fed member, and I think he was the most hawkish. So his highest of all the dots are no longer in there. So that was the change. And what I found interesting, though, in the dot plot update is you look past 2023 and 2024. There's lots of consistency there between the Fed members. But you start looking at 2025, and it's all over the map in terms of where the Federal Reserve members think interest rates are going to be a couple years down the road. It ranges all the way from as low as 2.5 to 5.75% on the overnight rate. So that was the one minor change that we had. The Jay Powell did go out of his way to remind all of those listening that the soft landing really is the primary objective of the Fed, but it's not the basic expectation, but it is their primary objective to bring down inflation, to cool off an overheating economy without upsetting the labor market and without pushing us into a recession. And at the moment, they remain on path for that.
And Adam, it's interesting that you say that, because I just stumbled across something from a year ago when they had the Jackson Hole, convention of Fed economists, and you remember, I mean, Kyle, you wrote about this, where Chairman Powell basically said, "Hey, what we're doing here is going to cause pain." I'm not sure, a year later, 13 months later, we've really felt that pain.
No, the economy still has a fair amount of strength and economic momentum at our back. The labor market's still white hot. I mean, my goodness, we have 3.8% unemployment, so economic growth has still been pretty good. The labor market has been pretty good. Inflation has been cooling, and that's coming down. So the pain hasn't yet been felt.
And households wealthier than ever. Let's not forget that the stock market recovery we've seen this year has added to household net worth. It's added to consumers' feelings of wealth. If you've got more money in your investment account, especially if you're in that phase in life where you're living off that money, well, seeing a bigger number helps you think, okay, well, maybe I can't afford to take that trip. Maybe I can't afford to run to the store. Maybe not always the thing the Fed's hoping for when it comes to getting inflation under control, but it helps to feel wealthier.
It's not just the wealth effect. It's income. Long-term, people don't spend their wealth, they spend their income. And consumers drive 70% of our economy, which is why we spend so much time talking about consumers in the first place. But we're able to now say that wages are rising faster than inflation. You couldn't say that a year ago, but you can say that today, and it's underpinning a lot of the economic strength we've had so far this year.
Tom, Bob spoke at length at the seminar this week. We've got another seminar next week, and encourage all of our listeners to come out. But one of the things he talked about was China. One of the things he talked about was this risk of China slowing, us not really fully understanding the data. It's amazing to me, and you were talking about this with us a little bit before the program, it's amazing to me the lengths we have to go to sometimes to see just how strong or weak the Chinese economy is. You just saw a headline or a data point that was kind of pointing to the fact that maybe China's doing a little bit better than some of us thought based on some kind of out there measurements.
Yeah, it's interesting. I mean, I think we're all have become pretty used to China not trusting Chinese data coming out of there. Not only this kind of snippet I picked up from Schwab and one of their analysts and what they do is they've been tracking air pollution index in China. And so what they've noted is in the second quarter that, and usually I guess I should backtrack just a bit and say that the air pollution is more or less a sign of manufacturers online and working at full steam. And so they saw an increase in air quality in the second quarter, generally a sign that factories have slowed down. But in the last couple months since the stimulus measures kind of taking hold here in late July, that air pollution, is gotten worse, and just a sign that economic activity is picking up. And it kind of echoes a sentiment that I've heard from another fund manager. Again, not being able to fully trust data and the accounting that comes out of some of these Chinese companies. But another measure that I've heard and seen them use is that they will use satellite images of highways and the amount of freight moving in and out, either from shipping or from semis on the freeways to get a general sense of the economic activity.
As an economist, as an investor, I never thought the day would come where I would be starting to track the smog in China to get a sense on economic output and activity. Yet, here we are.
And perhaps another place in which good news is bad news, right? That if the air's a little better, it means the economy's a little worse for China. And, not something that we want to laugh about all that much, knowing that we have some dependence on China, a lot less than Australia, Brazil, much of Europe. China's one of their largest trade partners. For us, it's up there. Mexico now our largest trade partner, but also the dependence we have on China isn't all that isn't all that great compared to much of the rest
Also,
of the
the
world.
dependence on data, on information. And when you can't trust a source, the lengths that you go through to try to figure out, to fact check, basically, what China's saying about its economy.
I think the big headlines that are coming up, all pointing to more potential disruption for markets ahead. We can point to the Fed and say, yeah, that was part of the cause this week. I think you add the potential for a government shutdown next Friday. You add the UAW strike that clearly is going to have an impact on bottom line. I'm sure, Tom, that you're starting to get some of these questions. But how do you talk about bigger picture to customers, to investors, when they're looking at some of these day-to-day headlines and going, what do I do?
Yeah, I mean, Adam and I were just talking about a little bit about that before the show, and honestly, I haven't gotten the question yet. I anticipated maybe one coming up, and I would kind of lean back on, unfortunately, we've been here before. It's pretty consistent that we come to this deadline about this time of year on an annual basis with facing government shutdown. But truth be told, what the numbers suggest is that the market in the last 5 instances this time of year, the markets have gone up in each occasion. The worst government shutdown was about 35 days, I believe, from 2018, 2019. And the day trading after that, the markets were down 2.7%. Immediately the following day, the markets were up 5%. And over that 35-day period, the markets were up 10%. So, just because past performance is no indicator of future returns, take that with a grain of salt. But nonetheless, markets kind of shrug it off and may see it as an opportunity.
I actually got 2 questions this afternoon on, hey, Adam, what's up with the government shutdown? What do I need to know? The message that I shared in both of those phone calls was we've gone through this before. We've had, I think, 10 government shutdowns in the last 40 years. So we've been through this before. And in past, government shutdowns have been short-lived. They've created some uncertainty, and they've also been great buying opportunities. So if we get one, maybe get out the checkbook. And I think it really kind of hits home to what we do as an investor, because you don't own shares of the government, but you own shares of businesses. And even if the government shuts down, remember who's open for business and making money: corporate America.
They are, unless you're a union auto worker, I guess, and in which case we're dealing with much of the same. I think this, in particular, on the union auto worker side, speaks to a larger issue, and that is that business is in the midst of a massive technological transformation. And if you're a union member right now for the auto workers, you're looking at an environment in which 4 or 5 years from now, you might be dealing with a 20% reduction in your workforce. How do you navigate that reduction? Well, one of the things you might consider, which, by the way, the UAW has done, is say, well, let's negotiate 20% fewer hours. Let's keep all our workers, just have them work a little bit less. And if we can get them paid the same or a little bit better because we've made some concessions in the past, then perhaps you're getting to the place you're going to be anyways. And so I think that's a lot of the math that's out there right now when we look at that particular issue. Is this is just setting up for where we all know we're going to be in a few years in the first place. The government, maybe the other side of that, it's not a technological shift. It's more of the same dysfunction. And if you're the Fed, maybe you're applauding the fact that you might get some help for a little while from some lower or some weaker economic data. If we do end up having to furlough some government employees, if we do end up holding back on some of those paychecks, of course, that's a really challenging environment if you're one of those government employees. And of course, I think, one more reason why it's so important that we do put it into those negotiations in a positive way. But to both of your points, we've been here before. We've found ways out of these situations. And once you remove that uncertainty, it tends to be a pretty significant positive for investors. Joel, a fairly quiet week on the economic front, but some housing data that suggests some more weakness, maybe in part on less inventory than what we really need out there.
That's right, Kyle. I mean, the higher interest rates haven't helped. They've, doubled in the last years for the mortgage rate, and so that makes it harder for some people to afford houses. But the real factor that's been at play for a while is inventory. the National Association of Realtors came out with their existing home sales numbers for August, and they were down for the third month in a row. They're 15% behind the year ago pace, and yet the average price, the median price, kept going up, and that's because of inventory. They have about half of what the inventory should be for them to keep prices stable. So even though the demand for housing is up because of the low inventory, the prices keep going up. And then, if you've got low inventory, then we'll just build more houses, right? And we had record levels, since the 1970s, we had record high levels of housing under construction in this country up until about a year ago. And so the Department of Commerce came out with housing starts and building permits numbers, and within theirs, they have numbers on houses under construction, and for single-family houses, that's been declining for 15 months in a row. So you're seeing that weakness show up in the home building as well.
And one of the challenges, obviously, is that if you have these higher interest rates, you're in a house with a mortgage at 3%, the last thing you want to do is take out a new mortgage to build a house or take out a new mortgage to upsize. And so what we're seeing now is some more creative solutions to those problems. Continuation mortgages, one of the conversations where you buy a house from somebody, you assume their mortgage, you assume their payments, you assume their rate. The catch there is you've got to get the bank to agree. Most banks, most loans, the way they were structured when the homes were initially purchased, they didn't have provisions that allowed for that. And so it's a challenge that could help the housing market if we can find some more innovations, some more solutions on the interest rate front. It could help free up some inventory as more people go, okay, well, now I don't have to borrow at 7 or 8. Now I can take over this loan at 3 and just keep making payments and throw a little extra cash down to buy out the equity. The other one I've seen is one of the nation's largest home builders has actually begun acting as their own bank and basically saying, hey, in markets in which we're seeing real signs of trouble, we want to keep building, we want to keep our people employed, but people just aren't biting at 7%. Well, they're offering mortgage rates, 30-year mortgage rates that are almost 200 basis points lower than what you can get at the bank. And they're doing it basically by saying, we're going to underwrite this loan for you. We're going to be the one that sponsors it. Yeah, they get to sell you the house. And so my guess is they're probably getting their money on the other end by allowing the house price to be a little higher than it otherwise would. But as a buyer, if you can spread that out with a lower rate over 30 years, those are the kinds of innovations that should help the housing market beyond just seeing lower rates, because as we've been talking about, this may be where rates are for a little while longer. Joel, we got some unemployment data as well, or rather some initial claims for unemployment data. Signs that the labor market's doing more of the same, perhaps?
Right, yeah. So it's, the labor market has been strong, and that's, part of that is demographics. And, we're talk about, a lack of housing. We've got a lack of workers as far as just, sheer numbers. And so that's been working to workers' advantages as the UAW is hoping to find out. And the numbers this week from the Labor Department show from the latest week, it shows that unemployment claims, initial claims, are the lowest they've been since February. So that's a strengthening in the economy, and I think that's part of what Chairman Powell sort of falsely predicted a year ago is the pain in the economy. I don't think workers have really been feeling the pain that was expected from these higher interest rates, and that's one of the things that's keeping the economy strong, as you explained before, and that's one of the reasons that if these higher rates can keep inflation down, we might have a softer landing, because the employment situation in itself is helping the economy be stronger.
And no doubt some of the headlines we're talking about this week are going to make their way into some of this labor data, add some noise to unemployment claims, add some noise to the unemployment rate even, as we look at the potential for furloughed government workers, as we look at the potential for some of those union auto workers that are striking to show up in different ways, even some of the services that go into those automotive jobs. seeing some impact now with furloughed workers. And so I would not be surprised if the data shifts a little bit in the months to come as long as this continues on. A reminder, of course, that these are volatile pieces of information if all you do is look at 1 month to month. And so the more important thing is trend, the more important thing is direction. And as we've seen now for the better part of this year, the economy is stronger than we could have hoped for at this point in time, that there's going to be no shortage of headlines that have the potential to change that story a little bit. But as we look ahead, remaining cautiously optimistic that we can navigate this, even if it's not the base case that Powell's talking about, that we can navigate this interest rate hiking cycle, this inflationary cycle, without too much of that pain that Powell's discussing. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.